Welcome back to another video. Today we're going to cover back testing for double top, and this time we're going to use gold. I noticed that a lot of people like to trade gold, so we're going to use gold to back test, and we're going to use the same method that we use for every single time frame, for every single pair, the Royalty FX Academy method, where we use the higher time frame to take our trade, monthly, weekly, daily, and we use the 4 hour as the lowest time frame to pull the trigger. All right. And we're using a price action, which is the bullish or the bearish engulfing bar. Okay. Now, all these setups, all these price actions, I have written a book for each one. We have the ultimate buying setup where you have every single setup that the market will give you. This book is now available on Amazon. Go take a look at that. And also, all my videos are on YouTube. All right. So if you want more in-depth detail, learning to understand how to trade these setups, go ahead and type in Royalty FX Academy on YouTube. You should be able to find me. So buying setups available on Amazon. And we also have the bearish force. Okay. So mastering the bearish force. This right here covers every single selling setup that the market will give you. All different variation, all 7 variations of double tops, how they may look like, and the price action that comes with them. All right. This book, again, covers every single setup that you will ever need to learn to understand when it comes to the market itself. All right. And we also have, again, the price action, the ultimate price action, the price action that guarantee you will work 97% of the time. All right. Literally that extra 3%, it's just the market doing its thing. All right. This right here, the first half is covering everything that you need to learn to understand about buying price action, how it looks like in all five to 6 different variations of them. All right. And the other half covers everything that you need to understand about the 5, 6 different variation of a bearish engulfing, how it may look like. All right. Now, these books are available to you at Amazon. Go ahead and take a look at them. And again, look me up on YouTube and you will be able to go over these videos in depth. You can learn with me or anybody else, and feel free to ask any questions, comments, like, share, and subscribe. I will respond accordingly. And if there's any pair in particular you would like me to backtest, please let me know and I'll backtest it to show you that this method works for every single pair. Okay. Freedom. This is what we do, right? We teach you freedom. We are teaching you how to set yourself free, understanding when the market will be buying, when the market will be selling. That way you're not in a chart for 24/7 waiting for a buy or a sale. Okay. Click buy, click sell, and get off the chart. Now, with that being said, let's go ahead and jump into this. So we are covering back testing. All right. So let's go ahead and knock out these rules real quick. That's something we always go over when it comes to back testing and what it is about. Now, when you are back testing, we need to have our 4 rules. Okay. Rule number 1 is, of course, the time frame that you are using. Okay. Rule number 1 is the time frame. All right. The time frame is very, very important because the time frame that you are using dictate the overall trend of the market. We want to understand if we have a bullish market or a bearish market. And the time frame that we are using is going to be the monthly, weekly, and the daily. All right. These are the time frame you are using. These time frame are used, again, for your technical analysis, the setup you are waiting for. All right. When somebody asks you, or when you ask yourself, what time frame do I trade? That will be the time frame you get your technical analysis from. Now, rule number 2 is, what time frame are we using to enter or trade? What time frame are we going to wait for a price action to come to us? And that is the H4, okay, or the 4 hour time frame. Okay. All right. Now we're using the 4 hour time frame because it's big enough, it's time efficient, where you don't have to sit there and just simply wait for it. And it goes hand in hand with rule number 3. All right. Rule number 3 is the price action that we are going to use. Okay. Price action. Sometimes I do say PA. Okay. So that's the price actions. All right. The price action we look for to enter the trade. Since we are using the 4 hour for the lowest time frame to enter or trade, we already know our price action is going to be a 4 hour, either bullish or bearish engulfing price action. Okay. It goes hand in hand. Now, please remember, it's a 4-hour time frame interval, right? Which means your price action will be available between 1-509. So all you got to do is just simply wake up 5 minutes before the 5 minutes before the 1, or 5 minutes before the 9. And then once you notice that the market did give you a bullish or a bearish engulfing, all you do is just click buy or click sell, set your stop loss, of course, your TP target, and then go back to bed or go about your day. And then you go ahead and take a look at the market every 4 hours if you choose to. All right. Please understand you're taking a trade based off the higher time frame. So you could choose to look at it at the end of the day, which is like around 5 or 6 when the market closed. Now, rule number 4 is all stop loss. Okay. Or stop loss. All right. Or the SL. Okay. Or stop loss is where we place a risk, meaning that when we take a buy or a sell, we tell ourselves that, hey, no matter what happened, I am willing to lose $200, $100, $500. So when and if the market were to go against us, we only lose that 100, or we only lose that 200. Okay. That way we are not over leveraging and we're not gambling. All right. There's a system to this. And when it comes to stop losses, of course, now either if you are buying the market, right? So let's pick a blank slot real quick. All right. Let's put SL real quick. When it comes to stop losses, if you are buying the market, so let's just go over a double bottom real quick, equal lows. If you buying here, right, you're gonna look for the previous low. So let's just say this was a break, right? So meaning structure wise, okay, meaning market broke and came back to retest this point here. When you take your buy here, you want to look at the last low for your stop loss. Okay. Now, if we are taking a sell, right, when we get a double top where the market goes and give you 2 equal highs, right, we take our sell here. Now, due to the fact that we have 2 equal highs, we have to look at the wicks of the candles as far as where we place our stop loss. Let's just say hypothetically, right, if we had a continuation downtrend where we get a break and retest, right? So market is falling like so, right? See that? Boom, retest right here, right? Continuation. Here we take our entry, that's our sell right here. And then last high is where we place our stop loss, okay? And then we target the previous low and so on and so forth. Now, I could do the same thing again for a continuation uptrend, right? Where we take a buy. So we have a bullish trend where the market is giving you higher highs and higher lows. So at any moment in time, let's just say here, we got a break of structure, right? And retest here. So this is where we would enter for our trade. And then we'll target the previous low as the stop loss. This is where we place our SL, right? And then we start targeting structure highs, right? Now, the beauty behind this is, just in case if you guys never put it together, is because if you place your stop loss at a previous low or previous high, it's far enough if and when market go to that specific area, you will have a trend reversal. Like it's so far away that when and if the market go to that specific area, it will be a trend reversal. Okay. Well, let me throw this in there just in case, right? So for a buy, right? So we got uptrend continuation, right? Here is where we take our trade, right? So that's where we're gonna go take our trade. So market came back to the same area right here, right? So we look to buy right there. So let's we got that market here in that area twice. We enter here, or stop loss is down here. Now, when and if, okay, when and if market were to go back down to hit your stop loss, you see what happened? Structures, which was the previous high lows, right? Previous high low. Now we have a break of structure, right? Because it goes to this structure point. We have a break of structure. So, like I said, a trend reversal. Now, when and if market goes back here, we'll take the sell to come back down, right? So you see here, we take our buy. If market comes, it'll give you a trend reversal. So vice versa, if we have a double top, right? So let's just say we have it coming like this. We're going to do it with a downtrend where the market is giving you lower lows and lower highs, right? Boom, right? So here it is. So this is our previous structure point here. That's the break. That's the previous high. To be more specific, that structure point right there is a previous low high, right? So in a downtrend, you get lower lows, okay, where each low is lower than the previous low, and then you get lower high. Yes, it's high, but it's getting lower and lower, right? So for us to get a trend reversal, a previous high has to be broken, which would be this lower high right there. Now, so when, of course, we in a downtrend, we looking for our sales, right? So when and if, right? When and if market goes back up within this point, you take your sell, right? You enter here. That's your entry for your sell, okay? To come back down. Let's just say hypothetically, market does not go your way. Instead, the market continue up, right? You see that? You put your stop loss, again, your SL, that's where it would be, right? Market continue up to that structure point. What you end up having, right, is now market giving you, again, if it breaks above to give you a higher high, like so, because if it goes above to close above it, and then now you would wait for the retracement to buy it, because at this point, see, we got lower lows, higher high. Once we get a price action within this area, that same level, that same entry point will be considered as a higher low, I'm sorry, right? Where it is higher than the previous. You see that? Due to the fact that it has to go, due to the fact that it went to a previous structure point, it pretty much gives you another setup or a trend reversal. Now, if it would have stopped here, we get all selling price action. Once again, we take our sell here. We look at the previous high. We look at we look at the previous high for a stop loss, right? If again, if and when the market goes up, now we have a break of this structure, full complete break, where it matched the previous low high. Now we're gonna wait for the market to come back to here, so we could take the buy to continue up. See, trend reversal. So your stop loss is placed far enough at a specific structure for, and when and if it goes back to it, you actually get a trend reversal. All right. So everything has meaning behind it. We're not randomly placing our stop loss. We are not randomly buying the market. Okay. Everything is an educated guess based on our studies, based on our technical analysis, based on what we back test, forward test. All right. That way we're not gambling. That's how we create our system. Now, that was all rules. All right. Now, let's go ahead and back to this real quick. So when it comes to back testing, all right, so we're going to be covering, of course, double tops, which are the first type of setups the markets give us before it reverse, right? So again, our technical analysis will always be based off the higher time frame. So we got monthly, right? So that's like an equal high, right? I'm just going to change the variation of double top, of course. And then the second highest time frame we use is the weekly. Now, this double top right there is where the market failed to give you a high that's just as equal. And then, of course, the lowest time frame we use for our setup itself or technical analysis is the daily, is when we get a double top where it comes back up, it goes somewhat a little bit higher. Let me just generate a zone. That way you can understand. See that? It will be like so. All right. You see that? So again, this is monthly, weekly, and daily. These are the time frame you use or have to use when it comes to your technical analysis. Okay. Understanding the overall trend of the market will give you more freedom, more time to spend with your family and friends. And when the setup comes to you, it's easy as click. We're done. All right. Now, let's go ahead over some of these setups itself and how they might look like. Okay, so this is first one right here. Now, of course, we have it in candle form where the market's going up, right? We got a bullish trend and it stops here. It came back down. So now what we're going to talk about is our zone placement. When we are back testing, of course, we're understanding what the market did previously. One of the things that we need to understand is how to place the zone, right? When we go to the higher time frame, which is the first thing we want to do, either monthly or weekly, we want to click the line chart where we will have our chart looking like so, right? We got exactly turnaround point. Remember, the line chart shows you the exact turnaround point of the market, right? Combined together with the wick, right? That's your zone. That's what people call the liquidity. Why is it a liquidity area? Because the stop losses, the take profits, the pending orders, buy limits, sell limits, buy stops and sell stops all there are up there. So there's a lot of orders up there. So there's a lot of money up there. That's why a lot of time when the market, before it buys, it sells first. Before it sells, it buys first. So it's going to collect all that order before it goes where it needs to go. So the combination of the two is your zone. So back to the higher time frame, you change your chart from candles to a line, and then you just identify the turnaround point. You put it like so. Okay. Now I know it looked like it went above it. Cool. That's just what it is. Now, when it comes with the candle, so right after you do the line chart, it shows you the exact turnaround point. When you put it back to the candles, you want to identify the wick like so, and then you will run the zone like so. So really, you could put two line, or you could use the rectangle property. Now, the zone, if you're using just the candle itself, start at the close of the last bullish candle, okay? When placing your zone and you're using the rectangle property, right? You want to start your zone at the turnaround, at the close, at the close of the last bullish candle. So it will look something like so. All right. So this is your zone. Okay. So within here, you're looking for the market to stop and then give you your price action. Now, one more other thing I want to mention as we continue moving forward.